Can you really retire on $500,000? I built a $500,000 retirement strategy plan. We got requested by a Patreon supporter and about 3 or 4 of our YouTube subscribers. And they're all looking at it saying they're struggling with today's times of how do I invest my money? I only have about $500,000. So we thought this was a good thing to go out and put this to the test. Can we do it? Welcome back to the channel. I'm Doug the Retirement Guys with all the monthly ETFs. Let's get into today's video. If you're not a subscriber, don't be afraid. Hit that subscribe button, hit that bell notification. We're here to help you grow your portfolio. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. The information provided in this video is for educational and entertainment purposes only. If you're looking for financial advice, always contact a financial advisor, as I am not a financial advisor. So with the big picture of retirement goals, with $500,000 saved for retirement, the goal isn't to grow it. It's to make it pay you reliability. We're not chasing the highest yields. We're chasing dependable income potential that can last. Now, I know I do everything with the monthlies, but we had to build a portfolio here with high monthly and weekly income for potential cash flow to cover the living expenses. We also evaluated that we make sure we have a NAV stability to protect the principal, and we do have some growth potential along with it. So when you do this, we have a balanced approach of income, stability, and growth across the board. So when we talk to basically the 3 different people that we put together, we kind of came up with an average across the board. And it came into this, is I asked them first off, what's your cost of living? And what do you want to do in retirement? So we came across with the cost of living is about $55,000 a year. So we're going to need a cash flow to cover those living expenses. Most of them wanted to travel. So we came up with a plan that, $10,000 a year should be well more than enough to travel on. And then everyone always talked about leaving an estate to their loved ones. So I thought these were all realistic, attainable goals, and nothing real out of whack for what people are asking for. So what I broke down here is I took the total allocation of $500,000. How are we going to break it down for them? We broke it down with 85% going to cost of living. So that's $425,000 to invest to generate the cost of living. 5% is going to go to the travel fund, and 10% is going to the estate fund. So cost of living needs $55,000 or $4,583 a month. Travel is about $10,000 a year or $850 a month. And then the estate, pretty much a 10% growth or $5,000 a year would be phenomenal. And it would cover every one of the bases that they're looking for. So I started off first in the cost of living. The first ETF that I used was JEPQ, the JP Morgan Equity Premium Income. This is one of the most trusted ETFs that's in the marketplace. It's been extremely reliable foundation for most retirement income. It pays a monthly distribution, so the income potential from this one is extremely high. The yield currently at 10.32% as of November 10th. Generated some decent income. They use a coverage call strategy, and they also have a growth rate of 2.36% year to date as of November 10th. We look at the charts, it proves it very well. It proves that it's gone through some tough times with the downward of April 2nd, and it's recovered fairly well. We look at the long-term performance when you add in dividends and the growth of the fund, and you can see since inception it was 16.22%, year-to-date 14.98%, and year-to-date 12.20%. So some good foundation to build on. Number 2 is SPYI, the NEOS S&P 500 High Income ETF. Now this one plays in the S&P 500 High Income bracket. It still pays monthly distributions. The yield is 11.75% as of November 10th, 2025. Does the covered call strategy, has that 2.66% year-to-date growth as of November 10th. Doing the same thing, we look at the chart, almost identical. Had a drop off in April 2nd, which most funds did, pulled out of that fairly strong, and has been doing a decent over the past 6 months. The performance year to date 13.58, 1 year 13.9, consistency, and then since inception 14.36. Our third fund, this one I struggled with a little bit, but I know QQQI has done so well in my portfolio that I said you have to put this in there. Neos does a great job with the NASDAQ 100 high income ETF. This one gives you a 13.69% yield as of November 10th. It has the growth of 4.91. I know the chart says 4.93. You can see how this stuff changes so fast in making videos. So you got a nice 5%, and it had to drop off in April 2nd. So year to date, almost 4.93%. You look at the performance package, 16.4, 19.07, and 20.46. This is why I personally can't walk away from QQI. It's in my portfolio. I highly recommend this in a lot of people's portfolios for definitely for retirement packages. It does pay out that monthly cash flow. The fourth one that I put into it, and this is what we did, is we put a 4-post table together, and that is the EGGY or EGGY. Now this one here is a little bit newer, and not a lot of people know about it, but Nest Yield Dynamic Income. This one mostly invests large cap equity funds. The fund is actively managed and goes after large U.S. capital equities directly and synthetically. This one here is a huge yield, 21.48% as of November 10th. The growth, 0.20. So what they do is they put a lot of emphasis into creating income, not as much in the growth. When you look at this one in the chart, you will see it's done very similar to the other ones, where in April 2nd it dropped, it recovered itself back up. But it's been pretty much playing in that same $38 to $40 range almost all year long. The performance onto it, when you include dividends and growth, you can see year to date 20.45 and since inception 22.78. So with a $425,000 portfolio allocation, what I gave them is a sample of this. If you put this into 4 ETFs, equally spread across each one of them. I look at this as a 4-legged table. If you take out one leg of the table, your table probably won't tip over. It'll be a little unbalanced, but it won't tip over. You can still use the table accordingly. So each one of the funds got $106,000 put into it, and it gave us a total 14.31 blend of yield, and given a projected of $60,817.50 a year. That's an extra $5,871 extra a year over the cost of living goal that they originally established, which was their goal. So this thing gives you that as a nice buffer for them to play in. So 425 invested, they got their cost of living handled, and things look very, very promising. Now let's take a look at the travel leg. This one I did dip into weeklies. The first ETF that I use is WPAY. I think with the Round Hill Weekly Universe ETF, this is for someone who's not involved into weeklies and someone doesn't understand weeklies. This is a fun to experiment. This is one to look at. This is the one to do research on. It's based around the Round Hill Weekly Pay Universal Index. It's the fun of funds. It tracks the equal weight index of all the weekly pay single stock ETFs coming out of Round Hill. You'll see this a lot, that people like the Round Hill package. I personally have no fear with Round Hill. I have a lot of the investments of Round Hill in my portfolio. Now with weeklies, you have to understand You will have a lot of volatility in the pricing, because this is what how the funds create the large yield, is by volatility. You take a look at this one here, WPAY, a yield of 58.71% as of November 10th. And this one, you can see they rebalance this every single month. So there's no one particular fund that will just blow it out. They rebalance every month to keep things well organized. You can look at the timeline. It's down year to date, only down 1.54%. That's not NAV erosion. That is just price flexibility. That is just the pricing going up and down across the board. The dividends, you can see where they're really starting to establish themselves as a equal payer. Their distribution average is 67 cents per week. So that makes some big changes coming forward. Number 2, the HOYY Granite Shares Yield Boost Robinhood ETF. This one I put in there because of the growth that Robinhood has shown so far, and Granite Shares has done a very good job with their package. Inexpensive price to get involved into, and they do a daily 2 times leverage of the price and the performance of the Robinhood market. Paying weekly, the yield, this is the one you have to be very, very cautious with. The yield is 148.99% as of November 10th. With large, huge yields that you see on both of these two funds, you have to know a little bit more what you're doing. You have to do your due diligence. You've got to look into these funds. When you take a look at them, they're down 19.27% year to date. It has bounced around a little bit, and it follows almost what Robinhood has done. They're looking for volatility. Their distribution average is 62 cents. So with a $25,000 portfolio allocation, what I have thrown into there with the 2 ETF funds, they're going to generate $21,742.05. So more than enough of what their traveling budget is asking for. So what I also proposed is that you take and do a 50-50 drip, which is you take 50% of it, go enjoy your travels. Take the other 50% and pour them back into the 2 funds. The reason for that is that will make up for any drops, any NAV erosion. You are basically reinvesting back into the funds to continue slowly keeping your $25,000 portfolio full at $25,000. Now that's not guaranteed. That is not. That is just a simple investment policy that you do a 50-50 drip, live off of some of the income, re-drip it back in there so you can continue doing this. So 2 very popular, very good weekly pays to play around with. The allocation's a little bit differently. If you look at 80% of it went into WPAY, because I believe with the NAV is safer in WPAY, but nothing of these weeklies are ever safe. So the estate leg. Now this one has thrown me a little bit for a curve, and I will tell you this. The first fund I suggested that they use is VOO. It's a Vanguard S&P ETF. This one has had a steady, it's been out there for years. This one has a steady about 15% return across the board. Look at the performance. It pays quarterly a dividend, very small dividend, but it's had a nice 14.49% growth as of November 10th. And you look across the board, everything flows into right on, I said, that 15% mark. But the one thing I did throw to these, and I said this, what you need to do is, if you want, buy a life insurance policy. Now, unfortunately, I hate to talk like this, but if you pass away, enjoy your money, enjoy what you do, enjoy life. When you pass away, the best way to give an estate to anybody is to buy a life insurance policy. Buy the life insurance policy, they generate the money from that, and anything extra left in your portfolio is a bonus for them. So that's how I would handle your estate leg. Take the little bit of money, put it in there, let it grow. 15% will definitely achieve what you're looking for, but I would also invest the money money into a life insurance policy. So giving you a summary, they want $55,000 a year or $4,583 as their goal. With using the platform that I put together, they will have $60,817 a year or $5,068 for a gain of $484 a month, which is almost another $5,000 a year. The travel fund, $25,000 a year or $2,083. The result, they're going to achieve. They're only needing $10,000 a year to travel. They've achieved that even with reinvesting 50% back into the fund. And then the estate, they're looking for a 10%. We're showing them how to get 15%. And they're getting $725 in dividends, which possibly could even buy the life insurance policy we're talking about. Overall, we hit every one of their goals. Now, the risk management. This is the thing that we have to always talk about, and the reinvestment strategy. We're reinvesting 50% of the travel income back into the fund to keep that fund alive and going. Maintain a cash reserve. You need to make sure you keep a 3 to 6 month of expenses in cash reserve. They're going to have that with the additional money that's coming from the $425,000 of investment. The weekly pay ETFs are flexible. You can use whatever you like to use. I just believe that WPAY and HOYY is a smooth cash flow to help cover those travel expenses. And the thing is, if you're not living off of it, if the one of the funds quits paying or things slow way down, you're just not going to travel as much. And then quarterly review. You want to make sure you're monitoring your NAV erosion, your assets. You want to check out everything. And I use these 5 circles down below, which is what I always suggest with anyone looking at these kind of portfolios. Is 1, you're looking for income. 2, you're looking for reinvestment. 3, you're looking to grow something to get ahead of inflation. And you want to monitor, and then you want to adjust your portfolios as you go along. My final thoughts, making it work. Retiring with $500,000 indeed is a feasible goal when you approach it with a well-structured, income-focused plan and disciplined execution. You need a well-structured plan, you need the risk control, and you need the discipline of executing the plan that you have. ETF diversification, some income focus versus always growth focus, risk management, and then the discipline of reinvestment. So I believe you can easily retire with $500,000 if you follow a strict plan. So tell me what you think. What do you think of the plan? Is that feasible for you? Is it work? Let me know in the comments below.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.